What if I told you that over 90% of active stock pickers fail to beat the market? In today's video, we'll explore the base rate argument for index funds versus stock picking. You'll learn why most investors struggle to outperform simple index funds and how this knowledge can shape your investment strategy. Let's dive in and discover what this means for your financial future. Imagine you're at a party, and someone asks you, "What's the best way to invest your money?" You smile and think, "Should I pick individual stocks or go for index funds?" It's a classic debate. Now, picture this. Research shows that over a 20-year period, nearly 90% of professional stock pickers fail to outperform the market. Yes, you heard that right. It's like trying to win a game of poker against a room full of experts. Challenging, to say the least. So, which path should you choose? Index funds, with their diversified approach, or the thrill of stock picking, where you could either soar high or crash down? In today's video, we'll explore the base rate argument, helping you understand the odds you're up against. If you find this topic intriguing, don't forget to like, share, and subscribe to Chill Finance for Real Life. Let's dive in together. Welcome to Chill Finance for Real Life. Before we dive in, please remember this video is for educational purposes only. It is not financial, legal, or tax advice. We encourage you to do your own research and consider seeking professional advice if needed. Alright, now let's zoom out and explore the base rate argument in the context of index funds versus stock picking. Imagine you're at a party, and there are 100 guests. Each guest represents a different stock. Some are dancing, some are chatting, and a few are standing alone. The question is, how do you choose who to dance with? Index funds are like a group dance. They allow you to join in with all the guests, giving you a piece of the overall party. This approach often leads to steady returns over time. On the other hand, stock picking is like trying to find that one perfect dancer in the crowd. It can be exciting, but it's also risky. Research shows that most individual stock pickers underperform compared to the overall market. So, let's break it down. If the average return of the market is around 7% per year, and inflation is about 3%, your real return is 4%. If you're picking stocks, you need to outperform that to come out ahead. But what if you miss the big moves? Just like at the party, if you focus too much on one dancer, you might miss the fun happening all around you. Here's a quick recap. Index funds provide broad market exposure and often outperform individual stock picking over time. Now, let's consider a rhetorical question. Are you more comfortable dancing with a group or trying to impress one specific partner? Ultimately, it's important to weigh your options carefully. Do you want to embrace the collective rhythm of the market, or do you prefer the thrill of selecting individual stocks? Remember, whatever you choose, make sure it aligns with your financial goals and risk tolerance. Thank you for joining us today on Chill Finance for Real Life. Welcome back to Chill Finance for Real Life. Today, we're diving into a topic that often stirs up a lot of debate: index funds versus stock picking. Specifically, we'll explore the base rate argument, which can help us make sense of which approach might be more effective for the average investor. Imagine you're at a party, and there's a game where everyone has to throw darts at a board. Some people are seasoned dart throwers, while others are just having fun. Now, let's say the board is divided into sections, and you win prizes for hitting specific areas. The seasoned players might hit their targets more often, but the average person just throwing darts might land a bullseye every now and then too. This scenario mirrors the world of investing. When you pick individual stocks, you're like that seasoned dart thrower. You're trying to hit the target with precision. But here's the catch. Statistically, most individual stock pickers underperform the market. This is where the base rate argument comes into play. The base rate argument suggests that if you look at the historical performance of stock pickers, you'll find that a significant majority fail to beat the market. For instance, studies have shown that over a 10-year period, about 80% of actively managed funds underperform their benchmark indexes. That's a staggering number. So, let's say you invest $100 in an index fund that tracks the market, which typically grows at an average rate of 7% per year. After 10 years, your investment would grow to about $198. That's a nice return, right? Now, consider the stock picker. If they manage to pick a stock that grows at the same rate of 7%, their investment would also grow to the same amount. But here's the twist. The stock picker has to consistently choose stocks that perform well over that entire decade. The odds are stacked against them. And let's be honest, most of us don't have the time to research every company, track their performance, and make informed decisions like a full-time investor would. It's like trying to hit a bullseye with every throw when the average dart thrower misses more often than not. Now, you might be wondering, what about those stock pickers who do succeed? They're the exceptions, not the rule. Think of them like lottery winners. Sure, they exist, but the chances of winning are slim. So, if you're looking for a more reliable way to grow your wealth, index funds could be the way to go. They offer diversification, lower fees, and the peace of mind that comes with knowing you're investing in the market as a whole, rather than trying to guess which individual stocks will outperform. Let's take a moment to recap. We've talked about how most stock pickers underperform the market and how index funds can provide steady growth. The base rate argument shows us that while stock picking can be exciting, it's often more of a gamble than a strategy. Now, here's a question for you. Have you ever tried picking stocks, or do you prefer the steady approach of index funds? Share your experiences in the comments below. As we wrap up, remember that investing is a journey. Whether you choose to pick stocks or invest in index funds, the key is to stay informed and make decisions that align with your financial goals. Thanks for joining me today on Chill Finance for Real Life. Until next time, keep it calm and keep it informed. When we talk about investing, a common debate arises: index funds versus stock picking. Today, we're going to focus on the math behind this discussion, using a consistent interest rate of 7%. This rate is a long-term average return for the stock market, considering both growth and dividends. Let's consider a scenario where you invest in an index fund. Imagine you invest $1,000 today. With an annual growth rate of 7%, we can see how your investment grows over time. In the first year, your investment grows to $1,070. That's $1,000 plus 7% of $1,000, which is $70. Now, if you leave that money invested for 5 years, we can calculate the future value. After 5 years, you would have approximately $1,493. This is because each year, your investment earns 7% on the previous year's total. So, you keep adding that growth on top of the original amount. What about 10 years? If you stay invested for 10 years, your $1,000 would grow to about $1,971. That's a significant increase, all from just letting your money sit and grow. Now, let's shift gears and talk about stock picking. Suppose you decide to pick individual stocks instead of investing in an index fund. The allure of stock picking is that you might find a stock that outperforms the market. However, the reality is that many investors struggle to consistently beat the market. Let's say you pick a stock that you believe will outperform the market. You invest that same $1,000. If you're lucky and the stock performs well, let's say it grows at a rate of 10% per year. After 1 year, your investment would grow to $1,100. But what happens if you don't pick the right stock? If the stock market dips, your investment could lose value. For example, if your chosen stock drops by 10% in the first year, your $1,000 investment would decrease to $900. The key point here is consistency. Index funds typically provide steady, reliable returns over time. In contrast, stock picking can lead to unpredictable outcomes. Now, let's consider a longer time frame. If you manage to pick stocks that grow at an average of 10% for 10 years, your $1,000 would grow to about $2,596. That's impressive. But remember, this assumes you consistently pick winning stocks, which is a challenge for most investors. On the other hand, if you invest in an index fund for 10 years at that steady 7% growth rate, your $1,000 would grow to around $1,971. While that may seem less exciting than $2,596, it's important to remember that the index fund carries significantly less risk. Now, let's pause for a moment. Think about this. How many times have you heard stories of friends or family who tried stock picking and ended up losing money? It's not uncommon. The base rate argument comes into play here. Studies show that the majority of active stock pickers do not outperform the market index over the long term. This means that if you're relying on stock picking, you're going against the odds. To illustrate this further, let's consider a scenario where you invest in an index fund for 30 years. Assuming a steady 7% growth rate, your initial investment of $1,000 would grow to about $14,900. That's the power of compound interest working in your favor. Conversely, if you were to pick stocks and manage to achieve a 10% return, your investment could potentially grow to about $17,400. While that seems higher, remember that this scenario assumes you've consistently picked the right stocks, which is a rare feat. So, what does this mean for you as an investor? The math clearly shows that index funds offer a more reliable path to wealth accumulation, especially over the long term. The less risky nature of index funds makes them an appealing choice for many investors. As we wrap up this discussion, consider this. Are you more comfortable with the idea of steady growth or the unpredictability of stock picking? The choice is yours. If you prefer a calmer approach to investing, index funds may be the way to go. But if you enjoy the thrill of stock picking, just remember to tread carefully. Now, let's hear from you. What's your experience with investing? Do you lean towards index funds or stock picking? Share your thoughts in the comments below. Thanks for joining me today on Chill Finance for Real Life. Remember, investing is a journey, and every decision counts. Meet Sarah, a 35-year-old teacher with a passion for travel. After years of saving, she finally has enough to consider investing. Sarah's friends suggest she try stock picking, claiming it's the best way to make money. Intrigued, Sarah spends hours researching companies, reading financial reports, and following market trends. However, after a year, she realizes she's not seeing the returns she hoped for. Her portfolio is up by just 2%, far below the average market return of 7%. Frustrated, Sarah decides to switch to index funds, which track the overall market. In 5 years, her new investment strategy yields a return of about 35%. So, what's the lesson here? Sometimes, the excitement of picking stocks can overshadow the steady growth of index funds. Now, let's look at Jason, a 25-year-old software developer. He's tech-savvy and believes he can beat the market. Jason invests in several tech stocks, convinced they'll skyrocket. But after 2 years, his portfolio is down by 15%. Feeling defeated, Jason learns about index funds and decides to invest in one that reflects the tech sector. Over the next 3 years, this fund grows by 21%. Here's a thought. Would you rather take the risk of picking individual stocks or enjoy the consistent growth of index funds? Next, we have Maria, a retired nurse in her 60s. With her savings, she wants to ensure her retirement is comfortable. Initially, she tries stock picking, focusing on dividend-paying companies. But after a year, her returns are only 4%. Maria then shifts her strategy to index funds. Over the next 5 years, her investments grow by nearly 40%. It's a reminder that even with experience, the market can be unpredictable. Lastly, consider Leo, a high school student who just got his first job. He's eager to invest but feels overwhelmed by the stock market. Instead of diving into stock picking, he opts for a low-cost index fund. After 10 years, Leo's investment grows significantly, demonstrating that starting early with index funds can lead to impressive results. What's your investment strategy? When it comes to investing, many people wonder whether to choose index funds or to pick individual stocks. Let's explore the base rate argument, which is a powerful concept in this debate. First, consider the average performance of professional stock pickers. Research shows that over a span of 15 years, about 80% of them fail to beat the market. That's a staggering number. If even the experts struggle, what makes us think we can do better? This leads us to the idea that index funds, which aim to replicate market performance, may offer a safer route for most investors. Now, let's talk about diversification. Index funds hold a variety of stocks, which spreads your risk. Imagine you invest in one company, and it faces a downturn. Your entire investment could suffer. In contrast, with an index fund, if one stock drops, others may balance it out. This built-in safety net is a significant advantage for everyday investors. Next, let's touch on fees. Actively managed funds often come with higher fees due to research and management costs. On the other hand, index funds typically have lower fees. For example, if you invest $1,000, that difference in fees can compound significantly over time. Lower costs mean more money stays in your pocket, working for you. Have you considered how fees impact your long-term gains? Now, let's discuss the emotional aspect of investing. Picking stocks can be stressful and time-consuming. You might find yourself constantly checking news and prices. Index funds, however, allow you to adopt a more hands-off approach. This can lead to less anxiety and more peace of mind. Wouldn't you prefer to spend your time enjoying life rather than worrying about market fluctuations? Alright, now let's zoom out and think about time. Investing is a long-term game. Historically, the stock market has returned about 7 to 10% annually, adjusted for inflation. If you invest $1,000 today, it could grow to around $20,000 in 20 years, assuming a consistent return. This illustrates the power of compound growth, which index funds leverage effectively. Lastly, let's reflect on the importance of patience. Successful investing often requires a long-term perspective. Many investors get caught up in short-term trends and make hasty decisions. Index funds encourage a buy-and-hold strategy, which can lead to greater gains over time. How do you feel about waiting for your investments to grow instead of chasing quick profits? So, as we wrap up, think about your own investing style. Are you drawn to the excitement of stock picking, or do you prefer the steady approach of index funds? Share your thoughts in the comments below. Remember, investing is a personal journey, and understanding your preferences is key to success. Alright, let's take a moment to address some common objections you might have about index funds versus stock picking. First up, some may argue that stock picking allows for greater potential returns. Sure, the idea of finding that one hidden gem is appealing. But consider this, the majority of professional fund managers struggle to outperform the market over the long term. A study found that only about 20% consistently beat their benchmarks. That's like flipping a coin and hoping for heads every time. Now, let's talk about control. Some investors feel that picking individual stocks gives them more control over their investments. But here's a thought. Is it really control if you're spending countless hours researching and stressing over every market move? With index funds, you're spreading your risk across a wide variety of stocks, which can be a lot less stressful. And what about fees? Stock picking often comes with higher transaction costs and management fees. Over time, even a small percentage can eat away at your returns. Imagine if you're paying 2% in fees versus a low 0.2% for an index fund. That difference can add up significantly over decades. So, I ask you, is the potential thrill of stock picking worth the risk and stress? Or would you prefer a more straightforward approach with index funds? Take a moment to think about your own investing style. Do you want to be a stock sleuth, or would you rather let the market do the heavy lifting? Let us know in the comments below which approach resonates with you. Your thoughts might just spark a great discussion among our community. Welcome back to Chill Finance for Real Life. Today, we're diving into a fascinating topic, index funds versus stock picking, focusing on the base rate argument. So, what exactly is the base rate argument? Simply put, it's the idea that most active stock pickers underperform the market over time. Think about it, if you have 100 stock pickers, statistically, only a handful will consistently beat the market. This leads us to a crucial question. Why take the risk of stock picking when a diversified index fund could provide steady growth? Let's break this down with a simple example. Imagine you invest $100 in an index fund that tracks the overall market. Historically, the average market return is around 7% annually after adjusting for inflation. Over 10 years, that could grow to about $198. Now, consider stock picking. If you choose individual stocks, you might hit a home run, but you could also lose your entire investment. Alright, now let's zoom out. The odds are stacked against active stock pickers. Research has shown that around 85% of them fail to outperform index funds over a 20-year period. That's a staggering statistic. So, what's the takeaway? For most investors, especially those who prefer a hands-off approach, index funds offer a reliable way to grow wealth without the stress of constant monitoring. Before we wrap up, I want to hear from you. What's your experience with index funds or stock picking? Have you found one approach more effective than the other? Drop your thoughts in the comments below. Remember, investing is a journey, and finding what works for you is key. Until next time, stay calm and keep your finances chill. As we wrap up this calm exploration of index funds versus stock picking, let's reflect on a few key points. Index funds offer broad market exposure, which can reduce risk. Stock picking requires extensive research and time commitment. Historical data shows that many active stock pickers underperform the market. Diversification is easier with index funds, spreading risk across many companies. Emotional decisions can lead to poor stock picking outcomes. Remember, investing is a journey, not a sprint. If you found this discussion helpful, please like, share, and subscribe for more insights. Stay curious, and remember, invest wisely, live freely. Thanks for joining me today. Next time, we'll delve into the power of compound interest and how it can transform your financial future. Don't miss it.